If you had invested $10 a day during the 2008 crash, you'd have over $400,000 today. But here's what nobody tells you. The people who made the most money didn't buy at the bottom. They were already invested before the crash even happened. And in the next 8 minutes, I'm going to show you exactly why that matters and how to position yourself right now so the next crash works for you, not against you. Market crashes separate investors into two camps: those who panic sell and those who build wealth. The difference? Preparation, not prediction. In this video, we're breaking down a practical approach to market downturns that doesn't require you to time crashes, pick individual stocks, or constantly monitor your portfolio. We'll explore defensive assets that historically perform well during market stress, examine 2 economic scenarios most people aren't ready for, and build a complete 3 ETF portfolio designed to weather uncertainty. By the end, you'll see how investing just $10 daily using this strategy could potentially grow into a portfolio exceeding $600,000, generating over $22,000 in yearly dividend income. The fear that keeps investors frozen. Let's address the elephant in the room. Right now, many investors feel uneasy. Markets seem stretched, news cycles swing wildly, and there's one persistent fear. What if I invest right before everything crashes? This anxiety is completely normal, especially when valuations feel high or recession warnings circulate. The typical response? Paralysis. People wait for markets to feel safer before investing. Here's the problem. Markets rarely feel safe at precisely the moment the best opportunities emerge. The most uncomfortable moments in real time often become the obvious buying opportunities in retrospect. 2 truths every investor must acknowledge. First, recessions are a feature of the economic system, not a bug. Throughout history, the economy has cycled through numerous downturns with different triggers but similar patterns. Growth decelerates, confidence evaporates, markets decline, then eventually rebound. Second, substantial wealth gets created during crashes, not despite them. When prices plummet while emotions peak, those who are prepared can capitalize, while those who panic lock in permanent losses. This emotional gap is where most mistakes occur. Rising markets breed confidence. Falling markets trigger fear. Instead of analyzing capital flows, people ask, how do I stop feeling this way? That emotional reaction transforms temporary market declines into irreversible financial damage. Why waiting for the crash usually backfires. After understanding that crashes create opportunities, many investors adopt what seems like a smart plan. I'll just wait for the next crash, then invest heavily. Sounds logical, disciplined even. In reality, it's a common path to missed opportunities. The issue isn't the strategy itself, it's human psychology. The version of you calmly planning to buy during a crash differs dramatically from the version watching your portfolio bleed value daily while headlines scream about economic catastrophe. Crashes don't feel like sales events. They feel like systemic failure. Your brain doesn't think great discount. It thinks, what if this never recovers? What if I'm catching a falling knife? This hesitation is precisely why most investors don't actually buy near market bottoms. They buy after recovery is obvious and safety has returned, meaning prices have already rebounded significantly.
Another challenge, crashes don't provide clear signals. Markets don't drop neatly, hit an identifiable bottom, then reverse. They whipsaw, they fake rallies, they create constant uncertainty. Waiting for the all clear usually means waiting too long. But here's the deeper insight. During crashes, capital doesn't vanish, it relocates. When stocks fall, money doesn't evaporate. It flows from certain assets toward others. Investors don't stop making decisions, they shift priorities. Risk becomes less appealing. Stability becomes more valuable. Liquidity outweighs growth stories. Focusing solely on falling assets feels chaotic. Zoom out to view the complete system and patterns emerge. Fear drives capital toward assets perceived as safer, more reliable, or more essential. This is why sitting in cash can backfire. While you wait for the perfect entry, capital is already rotating. Some assets are already benefiting from fear-driven flows. Others are being repriced in ways that create long-term value. There's another rarely discussed issue. Waiting demands confidence. You need confidence not just to wait, but to act decisively when opportunity arrives. Most people overestimate how confident they'll feel during an actual downturn. Fear doesn't sharpen judgment, it clouds it. Preparation beats reaction. Rather than attempting to time the exact market bottom, the better approach is positioning yourself so your portfolio doesn't trigger emotional decisions regardless of headlines. Understanding where capital typically flows during stress means you don't need perfect timing. You're not predicting the crash date. You're positioning so that market volatility doesn't work against you psychologically. This is why crashes reward investors who stay invested and disciplined, not those trying to jump in at the perfect moment. Success doesn't come from one brave decision. It comes from maintaining consistency while others hesitate. Instead of asking, when will the crash happen, ask better questions. What assets have historically held up when fear dominated? How can I use those assets simply without predicting the future? The power of ETFs during volatile markets. An ETF, or exchange-traded fund, sounds complicated but is beautifully simple. Instead of purchasing one company and hoping you picked correctly, an ETF lets you buy a basket of many companies or assets in one transaction. Instant diversification. Consider the difference. Invest $1,000 in a single stock, and you're making a concentrated bet on that company's execution, debt management, and survival. If that stock drops 50%, your $1,000 becomes $500. If the company fails, that capital can disappear entirely. Now invest that same $1,000 in an ETF holding 100 companies. Each represents roughly 1% of your investment. If one company collapses completely, you lose approximately $10, not $1,000. If one thrives, it contributes without carrying all the risk. This matters enormously during crashes. When markets fall, emotions run high, prices move rapidly, and news changes constantly. The last thing you want is constantly researching individual companies or deciding whether specific stocks might fail. ETFs reduce that pressure. You stay invested without micromanaging each position. You're not asking, is this company going bankrupt, but rather, is this asset class still serving its purpose? A much calmer, more productive question. During the 2008 crisis, the overall market fell around 35%. Many individual stocks fell 70% or 80% or went to zero entirely. Investors holding individual stocks had to make critical decisions about specific companies while fear peaked. ETFs offer flexibility. You can trade them like stocks without special accounts or lockup periods. You're simply choosing exposure. Let's be clear about what ETFs don't do. They don't eliminate risk. They don't guarantee profits. They won't shield you from short-term volatility. What they do is reduce single-point failure and help you maintain positions when emotions urge you to exit.
This is crucial because most long-term investing mistakes aren't caused by choosing wrong assets. They're caused by abandoning reasonable plans at the worst possible moments. What history reveals about crashes? Every major market crash has had different triggers, but investor behavior under stress has been remarkably consistent. The dot-com crash, 2000 to 2002. The internet was the future. Profits didn't matter. Companies with minimal revenue and unclear business models commanded sky-high valuations. When reality hit, confidence collapsed. From March 2000 to late 2002, the Nasdaq lost roughly 78% of its value. Many tech stocks never recovered. But not everything collapsed equally. Defensive businesses held up far better. People didn't stop buying groceries, toothpaste, or household essentials. Meanwhile, gold moved opposite to tech. Between 2000 and 2002, while the S&P 500 fell roughly 37%, gold gained around 20%. As equity market trust weakened, capital shifted. Additionally, geopolitical shocks like 9/11 pushed capital toward defense industries as government spending increased. The lesson? When growth expectations break, investors rotate toward tangible value and necessity. The financial crashes, 2008. This wasn't about hype, it was about leverage. Housing prices had been pushed beyond reality, and the entire financial system was built on that assumption. When housing cracked, confidence in banks evaporated. In 2008, the S&P 500 dropped about 38%. Many financial stocks lost 70% plus or failed entirely. Again, capital didn't disappear. It moved. Gold finished 2008 up about 5% as investors questioned banking and currency stability. Long-term U.S. Treasuries surged as rates were slashed, and money rushed toward government-backed assets, with long-duration Treasury exposure rising over 30%. Investors stopped chasing growth and started chasing safety. Consumer staples held up far better than discretionary spending. People cut travel and luxury purchases, but still bought food and basic necessities. The pandemic crash, 2020. This was different, not a slow buildup, but a sudden global shock. Entire economies shut down overnight. In just over a month, the S&P 500 fell roughly 34%. The pattern repeated. Stocks fell fast. Gold surged, finishing 2020 up around 25%. Long-term treasuries rallied as rates collapsed, gaining around 18% that year. Healthcare companies benefited as capital poured into vaccines and treatments. Consumer staples remained resilient. The pattern. Step back and look across all three crashes. Completely different triggers. Speculation, leverage, global shutdown. But underlying behavior stayed consistent. Risky growth assets suffered first. Confidence broke. Money rotated into three places. Gold, protecting value when trust fades. U.S. Treasuries, assets backed by institutions investors believe will pay. Defensive, essential businesses, companies people can't stop buying from even during tough times. Building the 3 ETF portfolio. These 3 recurring behaviors map to 3 simple ETFs. Let's break down each one.
ETF number 1 is IAU, gold. Gold has a strange reputation. Some swear by it, others dismiss it. The split comes from misunderstanding what gold actually does. Gold isn't a growth engine. It doesn't innovate, produce cash flow, or compound like businesses. Gold plays a specific role. It acts as a store of value when trust in the system cracks. During the dot-com crash, financial crisis, and pandemic, different crises, same instinct. When confidence faded and investors questioned paper assets, gold attracted attention because it's tangible and doesn't depend on promises. Gold doesn't always rise. During periods of high confidence, calm markets, and strong growth, gold can lag badly. That's the trade-off. Gold tends to work when other assets struggle. For everyday investors, owning physical gold creates friction: storage, security, liquidity, transaction costs. That's why many use IAU, a gold ETF designed to track physical gold's price as closely and efficiently as possible. Important details. IAU has a relatively low expense ratio, meaning less drag on returns. It doesn't pay dividends. Your return comes entirely from price movement. Gold's weaknesses. Can underperform for long periods. When economic confidence improves, gold often loses attention. Sensitive to sentiment. If fear subsides quickly, gold can give back gains fast. Not a get-rich-quick asset. Gold's value is in balance. It can reduce overall portfolio volatility and provide protection when other assets face pressure. Gold responds to expectations, not just inflation numbers. When people believe inflation will erode purchasing power and policymakers are losing control, gold attracts interest. Gold works best when sized appropriately. Too little and it doesn't help during stress. Too much and it drags performance during calm periods. The emotional component is critical. When stocks fall and headlines scream, seeing an asset holding steady or rising can reduce the urge to panic. That psychological benefit often matters more than raw returns. ETF number 2 is TLT, long-term U.S. Treasuries. When fear hits markets, it evolves into something specific, a search for safety. Investors want something they believe will pay them back regardless of conditions. That's where U.S. Treasuries come in. Treasuries are simple. You lend money to the U.S. government. In exchange, they pay interest and return your principal at maturity. They're considered among the safest financial instruments globally. Here's the crucial part many people miss. Treasuries have 2 components, price and yield, and they move inversely. When prices rise, yields fall. When prices fall, yields rise. During recessions, investors rush into treasuries for safety. That demand surge pushes treasury prices up, causing yields to fall. Simultaneously, central banks typically cut interest rates during slowdowns. Lower rates make existing bonds with higher yields more valuable. TLT holds long-term U.S. Treasury bonds, generally with 20-plus year maturities. Longer duration bonds are more sensitive to interest rate changes. This cuts both ways, increasing both risk and potential movement. When rates fall, long-term bonds rise much more than short-term bonds. That's why TLT has historically performed well during major recessions. In 2008 and 2020, when rates collapsed, Treasuries rallied sharply. TLT's biggest risk is interest rates. When rates rise, long-term bonds can struggle badly. Rising rates push bond prices down, and longer duration amplifies this effect. TLT isn't a growth asset. It's not designed to outperform stocks during long bull markets. Its role is responding aggressively when rates fall and fear peaks. In calm or rising rate environments, it can feel frustrating to hold. But that frustration is part of the trade-off. TLT tends to perform best when stocks perform worst. That negative correlation is incredibly valuable during true market stress. TLT also provides income, currently yielding about 4.01%, with long-term income growth around 10.34% through reinvestment and changing rate environments.
During crises, investors don't ask whether the system is perfect. They ask which part is most likely to pay them back. Time and again, Treasuries remain a primary destination for global capital during stress. Understanding two types of downturns. Not all downturns look or feel the same. There are two broad types. Deflationary panic. Demand collapses, spending slows, unemployment rises, markets fall quickly. Investors rush towards safety. Interest rates usually come down. This is when treasuries tend to perform well because falling rates push bond prices higher. Gold can also play a role when uncertainty peaks. Inflationary squeeze. Growth slows, but prices stay high. Costs rise, purchasing power gets squeezed. Confidence erodes slowly. Interest rates may stay elevated longer, pressing bonds and making growth investing harder. Nothing feels cheap or safe. Nobody knows which scenario comes next. Sometimes elements of both appear simultaneously. That uncertainty is exactly why building a portfolio around a single outcome is risky. This is where defensive businesses matter. Unlike gold or treasuries, they don't rely on fear or rate cuts. People still buy food and essentials. Income from these businesses makes it psychologically easier to stay invested when everything feels uncertain. ETF number 3, SCHD, Defensive Dividend Income. SCHD is built around high-quality U.S. companies that pay dividends, but it doesn't just chase the highest yields. It focuses on businesses with strong cash flow, solid balance sheets, and a history of returning money to shareholders, companies that can keep paying when growth slows. Chasing yield alone leads to fragile companies that cut dividends when conditions tighten. SCHD avoids this trap by emphasizing dividend sustainability and financial strength. SCHD's performance. Current dividend yield approximately 3.81%. Historical dividend growth last decade about 10.61% annually. Average share price appreciation roughly 8.06%. Growing income helps offset rising costs and protects purchasing power over time. SCHD isn't designed to explode upward in bull markets, and that's intentional. Its job isn't winning every year. Its job is reliability across many years, especially difficult ones. During strong bull markets, it may lag more aggressive strategies. During downturns, it often falls less and recovers more steadily. This trade-off is exactly why it works alongside gold and treasuries. Gold handles fear-driven spikes, treasuries handle panic-driven safety moves. SCHD handles the long, uncomfortable middle. It keeps working when markets are choppy or unclear. There's also a compounding effect. Dividends don't just provide income. When reinvested, they buy more shares, which generate more dividends. This snowball effect accelerates growth, especially when prices are lower. SCHD also provides diversification across many high-quality businesses, reducing the risk that one company's problems derail the entire strategy. The complete portfolio structure. Now we've covered the 3 building blocks. Let's see what happens when you combine them.
Portfolio allocation. 25% IAU, gold, no dividend, average annual price appreciation of about 14.79%, acting as value protection. 25% TLT, treasuries, current yield around 4.01%, Average dividend growth, around 10.34%. Average price appreciation, minus 3.33%, reflecting current rate sensitivity. 50% SCHD, defensive income. Current yield, around 3.81%. Dividend growth, around 10.61%. Average price appreciation, around 8.06%. Combined portfolio metrics. Blended dividend yield, roughly 2.91%. Average dividend growth, close to 7.89%. Long-term average price appreciation, around 6.9%. What $10 daily investment becomes. Instead of a lump sum or perfect timing, assume a simple habit, $10 per day or $3,650 per year. After 1 year, portfolio value, around $3,650. After 10 years, portfolio grows to around $58,131. After 20 years, portfolio reaches around $213,318. This is where compounding becomes visible. Market growth rivals your personal contributions. After 30 years, portfolio grows to around $644,388. Annual dividend income, around $22,445, roughly $1,867 per month. Where the value came from. Total value beyond contributions, around $534,888. Capital appreciation, around $350,323. Dividend reinvestment, around $184,565. This demonstrates how consistency, not courage, builds wealth. Systems beat gut feelings, and preparation beats trying to time the perfect moment. This 3 ETF portfolio isn't about predicting crashes. It's about positioning so you're prepared regardless of which type of downturn emerges. Each asset plays a different role, and together they create a structure designed to work when patience gets tested most. The next crash is coming. The only question is, will you be ready?